I 100% know that there is no good price discovery coming from Wall Street. And so when you're looking at the spot gold and the spot silver prices, it doesn't really, it's a trading market. That's not a true fundamental market. And ultimately, can't give you a lot of guarantees, but I can 100% guarantee that at some point, all assets, all instruments go to their true fundamental value. And silver's is much higher than $200 an ounce.
In today's distorted financial world, true price discovery has been replaced by market theater. The spot gold and silver prices we see on Wall Street aren't reflections of real fundamentals. They're products of a trading system designed for speculation, not truth. Yet history teaches us that all assets eventually return to their real intrinsic value. And for silver, that figure is likely far beyond $200 an ounce. One of the most revealing ways to understand this is by looking at our own currency's transformation. Decades ago, our coins contained real silver, each denomination logically tied to its metal content, a dime for roughly 1/10 of an ounce, a quarter for a quarter ounce, and so on. These coins represented tangible value. Over time, governments swapped out precious metals for base metals while maintaining nearly identical appearances, ensuring the public wouldn't notice the change. This is how transitions between fiat systems work, not through force, but by subtlety. Lynette Zang, a veteran analyst and educator on monetary history, often uses these visual comparisons to make the erosion of our money tangible. By placing a pre-1965 silver quarter next to today's quarter, the differences, especially in intrinsic value, become clear. She explains that similar shifts occurred when gold coins gave way to gold certificates, then to Federal Reserve notes, with corporations and government interests aligning to benefit from inflation. This inflation tax quietly transfers wealth from the public to those who control the system. Once gold and silver were removed from the monetary base, there were no longer strict limits on government debt. The result? Decades of unchecked borrowing, currency debasement, and the gradual stripping of citizens' financial power. Now, we present the clips from Lynette Zang's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
I remember it being our money. So what we did was we came up with what we call our coin cards, and we have a silver quarter on it pre-1965, and then we have a new quarter on it, because people need to understand that governments and central bankers have a lot of experience in shifting from one currency, one fiat money into the next fiat money. And the way that they get you to do that that you have to volunteer. If they force it, you know about it, and they don't really want you to understand it. So they make things look as close to normal as possible. But I think I did. But this is 1957 silver quarter, and this is a 2024 or 2023, whatever. It's a new one. And you can see that they look very similar, right? Except for the edge. This one's all silver. This has some color in there. This has value. It's almost a quarter of an ounce because it's 90% silver, and a quarter is a quarter. I mean, they were kind of logical. A dime is roughly 1/10 of an ounce, a quarter of an ounce, a $half, half an ounce, and it's silver dollars an ounce, roughly, because pre-65, they're all 90%. But that's the way they do it. And I love showing this example, except, you don't find them in circulation. And I'll tell you, as we're passing them out, because I hand them out everywhere I go. I go to the doctor's office, I give it to them, and I explain it. And I encourage people to join the Citizens for Sound Money movement, because we've got to get gold back in the system again. But I want you to look at this. This is pre-1933. So first you had this. Then they came up with the certificates, because it's so much more convenient to carry a bill in your wallet than this so heavy coin. Oh my goodness, right? You can walk in with this, you can walk out with that. But at the same time, and this is critical for people to understand, because it is happening again right now as you and I are sitting here speaking, corporations converted their corporate debt, and I have all the proof and evidence from the Fraser, so from the Federal Reserve itself, corporations converted their debt into Federal Reserve notes. So corporations were instrumental in shifting us into the system because governments wanted to tax and spend. So they created the inflation tax, and corporations wanted to pay you less. So inflation covered that puppy as well. So 20 years people worked with all three of them. And you can see there's the little gold thing to remind you of this. There's this $20 bill to remind you of that. When these two things went away, people didn't think anything had changed. But in reality, everything had changed because by giving up this, we gave up our power over the central banks and the governments. Because up to that point, if you did not like what they were doing, you'd walk in with this and you'd walk out with this. And that
you could have your physical.
Exactly. Well, you could have your physical, but it was more than that because when you took the gold out of the system, there were more restrictions on how much debt our government could grow. And they took us from this teeny little 20th of an ounce, which is a $1 gold coin, which was equal to a $1 silver dollar and equal to a silver certificate. Okay. So all of these three things were the same. When this went away, they still had those two for a while until 1965. And then that goes back to this change. So, and the other piece of that is critically important is that our government, I can't believe that they got away with this. And I mean, and I see it now and I'm understanding it better, but it's still just crazy to me because the sitting president at that time, President Johnson, actually said that if anybody tries to hoard this silver, which is what the Hunt brothers did, drove the price to $50. And then our government said, we stand ready to sell silver at $1.29 an ounce to maintain its price. I mean, why didn't people go, wait a minute, a government is talking about going in and manipulating the markets? No. But I was alive then. I remember it. I was a child, but I remember that. And I remember sitting with my parents and my aunts and uncles Friday night. I used to love listening to all their discussions around the table as they were playing penny ante poker. And I never heard them talk about it. So that means it didn't impact them. And my Uncle Al was one smart guy. Very smart guy. He knew how to accumulate gold when it was illegal to hold more than 5 ounces any other way than this. So the reason why I bring that up is this is a physical representation of Ethereum because there is no physical Ethereum, right?
Right.
Doesn't it look an awful lot like that? How about Bitcoin, right? And what do they call Bitcoin? Digital gold. How about XRP, right? Why, Ron? Why are cryptocurrencies, the physical depiction of them, gold, silver, or platinum? Are they trying to do the same thing? Yeah, the answer is yes. Yes, they are. They want you to think that that's just like gold and silver, but it's not. And there are lots of reasons for that.
The creation of the Federal Reserve marked a turning point in this process. Officially, it was about creating more flexible money, but in practice, it allowed the same amount of gold to back vastly more paper dollars, eroding purchasing power rapidly. Between 1914 and 1920, the dollar lost roughly half its value. The 1920s consumer credit boom further entrenched this system, providing the public with unprecedented access to debt while fostering a speculative culture. By 1927, central banks, including the Federal Reserve, were granted unlimited charters, removing even the pretense of temporary control. In the following years, as market speculation reached a fever pitch, the Federal Reserve tightened credit, triggering the 1929 crash. This pattern of expansion, speculation, and collapse is one we see repeating in modern forms today. Zang draws a parallel between historical gold-backed currency and today's cryptocurrencies. While often marketed as digital gold, these tokens differ fundamentally. They do not carry intrinsic value, nor are they used across every sector of the economy as gold and silver are. Gold is indestructible. Silver is consumed in industry. Both are finite, physical assets with centuries of proven value retention. Today, with nearly no purchasing power left in the currency, governments are seeking ways to create artificial demand for the dollar. Stablecoins, often used in countries with hyperinflating currencies, are one such tool. However, they also transfer risk back to the public, while underlying Treasury demand, the backbone of the global economy, continues to weaken. Let's get back to the interview.
If you read the documentations when they were creating this whole Federal Reserve system, that is actually what they said. What they said is, for governments, we need to be able to tax more and spend more, but gold creates restrictions on what we can do. And so that's why they did that. I mean, this little 20th of an ounce backed $1 when they installed the Federal Reserve, because what they needed, and see if you haven't heard this, more flexible money, right? Now, this little thing, instead of just backing $1, it backed $2.40. And that's what I'm trying to bring out when I'm talking about these Federal Reserve notes, because the Federal Reserve is neither federal, nor do they hold reserves, but it was corporate debt. And I'm telling you, I have all the evidence on it. Corporate debt was converted into Federal Reserve notes, and that's what actually created the Roaring '20s. But if you look at the purchasing power chart, you'll see a very rapid loss of roughly 50% between 1914, the beginning of 1914, into 1920. And then in the 20s, you regained a little bit of its purchasing power, because that was the beginning of it. And then all of that new money, that flexible money sloshing around the system, that was when the US started their consumer-driven economy, because that was also the first time in history where just the general public had access to credit. Right? Now, and they let them have lots of credit, especially in 1928. It's really interesting when you look at this, because I see it again, right? It's history repeating itself. But in before 1927, I believe. It could be 28, but I'm right in there. All central banks had a limited charter, right? So they were allowed to be in existence for between 15 and 20 years. Those were the typical terms, 15 or 20 years. This Federal Reserve was given a 20-year charter. Considering that they came out in 1913, that would put it that the end of their charter was 33. Well, is that a coincidence? I'm not sure, but okay. I just think it's interesting. 1927, for the first time in history, the Federal Reserve, or a central bank, and happened to be the Federal Reserve, was given an unlimited charter. An unlimited charter. And so I think it's coincidental that in 1928, that's when the big industrialists that knew that they had built this paper pyramid in the stock market, well, the public started getting into the stock market in like 27, and it kind of ratcheted up. By 1928, all of that Roaring '20 money was flooding into the stock market, owned more by the general public. And then the Federal Reserve took the credit punch bowl away, and we had 1929. Okay. Now, I don't know about you, but I'm watching an awful lot of risk transfer that has been taking place in here. And so I think we have a repetition, and I do not think that it's an accident that they're depicting cryptocurrencies as if they're gold. But you know what a huge difference is? I mean, there's lots of differences. Number one, this is used, and so is silver. These are both used in every single sector of the global economy. These are used in one place. When you mine gold, I have to speak about gold particularly because silver gets used up in industry. Gold is indestructible. So it takes labor and energy to mine gold, but then because gold is indestructible, it can be used over. That same level of energy can be transferred to every single sector of the global economy an infinite number of times because gold is indestructible. They want you to believe that this has value because it took energy and water to create it, but it doesn't store that energy or that water. It is used up.
Interesting.
So these are like really interesting pieces that people don't seem to talk about or understand. But what you do need to understand, everybody needs to understand this. I mean, I'm like as serious as a heart attack on this. Is there is officially virtually no purchasing power left in the currency. And so they have to create, that's what the Stablecoin Act was about, the Genius Act. Nah, I'm so sure it's genius, but okay. The Genius Act is about creating an additional artificial market for dollars because there's a huge race going on. We've just had abysmal auction results from our treasuries. But it's the 10-year treasury that underpins the global economy. So if countries and banks are not showing up to buy and hold that stuff, and that's been shifting for a long time, that's not something that's new, then somebody needs to be buying that stuff. And what they're really doing is transferring the risk to you through stable coins, and not necessarily to you, but all those third world countries, particularly in Africa, where their currencies are hyperinflating. And so people have glommed on to the US dollar stable coins because it's not losing value as quickly. But to your point, the more of this that they do, the less value everything out there has. And they've already gotten your purchasing power. So now they got to attack your principal. It's that simple.
The modern financial landscape is the result of over a century of systemic shifts, each step moving further from tangible, asset-backed money toward a digital and debt-driven structure. The problem is that the purchasing power of the dollar has been effectively destroyed, and history shows that once a currency's decline accelerates, it rarely recovers. What's happening now is a strategic transfer of risk and value from the many to the few. Just as the shift from gold and silver coins to fiat currency quietly stripped citizens of financial leverage, today's adoption of stablecoins and other dollar-linked digital assets is part of a global race to preserve U.S. monetary dominance. But these measures are short-term patches, not solutions. They artificially boost demand for the dollar, especially in weaker economies, while masking the underlying rot in the Treasury market, particularly in the 10-year bond, which underpins the world's financial system. The parallels to past crises are striking. In the 1920s, flexible money fueled a credit boom, stock market mania, and eventual collapse. Today, central banks, corporations, and governments are again aligned in promoting a system where debt expansion and asset inflation disguise deeper fragility. The difference now is that technology enables faster and broader implementation, and potentially swifter consequences when the system strains beyond its capacity. Gold and silver stand apart from this cycle. Their value is not based on a promise or a code, but on physical scarcity, utility, and centuries of trust. Silver, in particular, remains undervalued relative to its historical purchasing power and industrial demand. A return to its actual value would be dramatic, and for those holding physical metal, potentially life-changing. The lesson is clear. Understand the history, recognize the patterns, and position yourself outside the system's most fragile points. Fiat currencies come and go. Tangible assets endure. If you found this analysis helpful, please like this video, subscribe to the channel for more independent economic breakdowns, and share your thoughts in the comments. Your engagement helps keep these conversations alive.